Happy Friday, everyone. Rich Swerbinski with the Mortgage Collaborative here once again with the rundown with Rob and Rich, where we take you into the weekend by running through the week that was in the mortgage industry. Sorry about the halo effect I got going on here. It's some weird Cleveland winter lighting going on. But as always, pleased to be joined by my colleague.
Rich, it's not that you are actually Catholic and have been, there's some kind of, you're not an angel.
I'm a very bad Catholic. Maybe this is some kind of.
You're not an angel with the halo.
Yeah. So anyway, my esteemed colleague and co-host, Rob Krisman. Rob, great to see you as always. And where the hell are you?
I'm in Larkspur, California, which is about 15-20 minutes north of the Golden Gate Bridge, standing in a park.
Were you hiking? And
surrounded by redwood trees. For folks who've never seen a redwood tree, they're all very nice.
Rob, were you hiking in your suit?
What's that?
Were you out hiking in your suit? What are you doing?
I do have my hiking boots on, but no, I just flew back from San Diego this morning. When did you, Kate, it was nice seeing you at the conference. When did you head back to Louisiana?
I just made it home last night. I made a quick stop in Houston on my way back. So officially left the conference on Wednesday. Actually, right after the Empower lunch.
Ah.
Yeah.
We should probably introduce our other co-host.
Yeah, Rich, what are your manners?
Rob and I didn't have a co-host this morning. We're like, let's get somebody that's smart, funny, real.
Right. Smart. Rich, let me tell the audience, Rich, how that worked. You know, we're chatting, Kate, and he says, what about Kate? She's better looking than you are. She's smarter than you are. She's more successful than you are. He's talking to me. She's more literate. She can speak better than you can. And I went, so you got the nod.
Well, y'all always know how to make things funny. That's for sure.
Always
but happy to jump on quick and have some humor with you.
And we still haven't introduced her. It's the CEO of Eustace Mortgage, one of TMC's first members ever. She's on our lender board of directors. All around good gal, Kate deKay. Kate, great to see you. Thanks for joining us on No Notice.
You too. So I heard that you have hair now, and you do have hair now.
I have hair. Yeah.
Who
I thought I was bald. I've had hair the whole time. I just, I don't know why I've been bald really for a decade, but I have hair now. So it's irrelevant.
Looks nice.
What's your trick, Rich?
My trick to having hair? I don't know. I think it's just genetics. All the men in my family die with full heads of gray hair. So
yeah, they say it's supposed to be your mom's brothers, right?
Yeah, and that would be
mom's dad, maybe.
Yeah, all that would be accurate. So, but and also Kate, a diehard New Orleans Saints fans. Before we get started, got to get your take. The whole Saints off season. Sean Payton's a free agent. Your former coach. Looks like Dennis Allen's coming back. Who's going to be the quarterback of the New Orleans Saints?
Well, when you said that earlier, I didn't actually get to have time to go look to see, did we make some announcement on a quarterback that I didn't know about yet? Our last two seasons have been a struggle. Who knows what we're going to see here coming up before us. I'm not super stoked about our coach, to say the least. Certainly happy for Sean Payton and him exploring his options. I've heard some strange rumors about contracts that he's had for the next person that has to pick him up, that we're getting draft picks or something. I'm not quite sure what's all going on there, but regardless of what I think is going to happen, I will be at every Saints game that I can possibly be in attendance to next year, and my black and gold will be hard in my closet and on my body. Because no matter what, in New Orleans, we're supporting our sports team, especially our Saints.
What about I am a huge fan. I'm a Cavs fan, but my number 2 team is the Pelicans. I love Zion. I love CJ McCollum from Cleveland. I love Brandon Ingram. They just got a lot of guys I like. It's a really good young team. Is there a lot of buzz about the Pels in NOLA?
Definitely. So the young, fun team is really cool to watch. I went to a playoff game last year. I haven't been yet this year. Actually, my family's going tomorrow, so we'll be there supporting, but there's definitely a lot of talk and and they're getting good turnout at the games, and just, I think New Orleans is always about fun. So if we can create fun, buzz, have a fun young team, we always show up. So yeah, it's been cool.
Awesome, awesome. And the chat is already roaring away with Super Bowl predictions and New Orleans comments and all kinds of good stuff. So keep it coming. Keep the Super Bowl predictions coming. Throw them in the chat. Would love to hear who everybody thinks will end up in the big game and victorious. I've been on San Fran over Cincy. The second gambling went live in Ohio. San Fran beating Cincy in the Super Bowl was 45-1 odds, and I immediately threw nice little investment on it. So that's what
So
I'll be.
are you, I know with your location, do you dislike the Bengals because of where you are, or what's the situation there? I don't know.
You know, the Bengals are a hated division rival of the Browns, but you know, I mean, I hate the Steelers. I hate the Ravens. I don't like the Bengals, but it's hard not to get caught up in Joe Burrow and what he's done. And, you know, it is representing Ohio. So we'll see. Rob, your hand is up. You have a question?
I was hoping at some point we would talk about mortgage banking.
Oh, the mortgage industry. That's right. Yeah.
Okay, well, I was gonna say,
Oh,
you like
this
Joe
is-
Burrow. He's an LSU guy, so there you go.
I'm living in my alternate reality where I have a police sport. But sorry,
Moving on.
let's bring it back together. So, all right, let's go ahead and get into
I
it.
wanted to, yeah, let's get into it here. I don't, I saw Kate last week a little bit on the computer, on the laptop, and I saw her this week live and in person at the IMB conference. And Kate, I wanted to get hear your takeaway from the event. You were there for 2 or 3 days.
Yeah.
Thoughts?
So it's always interesting going into those, especially kind of in the market that we're in, and you really think you're going in and everybody's going to be very doom and gloom, and you know, it's just going to be a somber event. But I found it exactly the opposite. I found it encouraging to leave some, you know, of course, substantial information about, you know, from Fran and Tony with kind of his predictions of what's coming up in the year. Not to say that we don't have a hard few months still ahead of us, but it seems like we're clearing some hurdles and going to be in a much better position here as the year goes on. So thought the event was great. Of course, great location. I know TMC will be in San Diego in a couple months, so that'll be fun to head back out there. And I left feeling optimistic.
Awesome.
Rich, is the TMC, there was a rumor during the IMB the TMC event is at the Econo Lodge in downtown San Diego. Any truth to that? Where is the venue for a month and a half from now?
We moved it from the Econo Lodge to the Red Roof Inn due to the climate, but no, it's at the very posh Intercontinental Hotel, which is right on the water over in the marina, right like in the heart of like Little Italy area of San Diego. So really cool area of San Diego. So yeah, looking forward to that coming up a little over 5 weeks away. So
yeah. So Kate, I would agree. And Rich, I'd like to hear your opinion too, because some people think that counts. So my opinion is similar to, sorry, Rich, you know, my opinion is very similar to Kate's. You know, you go into these things and you wonder, you know, what's going to be like. It's a credit year, especially the second half of the year. Lenders took it on the chin in terms of revenue and margins and volume, and vendors are you know, reflecting that as well. And you kind of wondered what was going to happen. But yeah, people were upbeat. They were happy to see one another. There were definitely some big hitters there. Stan Middleman from Freedom, for example, just to throw out a name. Bill Lohman from American Pacific. Stephen Milner, of course, looking dapper.
Always best
And we were wearing the same necktie one day, actually. No, we were both wearing ties, but nonetheless, I think it was upbeat. I think in general, you know, the underlying sentiment was, you know, we've survived, we're here, we may as well make the best of it, kind of thing, and move forward. And so, yeah, there was a little bit of optimism, and if rates kind of down a little bit, and, you know, more companies go out of business. Some companies are just plain old going out of business, especially the smaller firms. And so you don't see that being represented at an IMB conference like that. But nonetheless, I think the companies that are around, like yours, Kate, I mean, the more companies that go out of business elsewhere, the better off. I mean, as as Machiavellian as that sounds, it's true, right? So
yeah, it's definitely a purge when you're in a situation like this, which, you certainly don't wish to many that are put in a bad situation, but it's certainly most of the time for the better for our business and for our companies once we get through it. And to your note, Rob, of course, at the conference, there was every M&A firm that could possibly be there asking if your company is interested in buying or selling, because that's what essentially everyone is interested. You're either want to buy someone or you need to sell.
yeah,
There's much of an in-between right now.
It's one of the things I love about the cyclical part of this industry. It's like, the bad cycles, the loss mid people, there's tons of them, and then they all go away. And, the non-QM and, it's the salespeople in more robust cycles, and just the ebbs and the flows of all that. Now it's, the M&A people are circling in the water for sure. So
yeah, there was definitely no non-QM people, vendors hanging around in this one.
The speaking of M&A, what makes the headline, like yesterday, or maybe it was this morning. This morning, I ran the American Pacific News. They bought another company, but companies like, well, I'm not going to name them, but large retail lenders don't necessarily have to go out and make headlines by buying a company. An obvious strategy is, if there's a weaker company out there, just to start hiring their producers or picking off their branches. And it's, once again, it sounds Machiavellian, but oftentimes when a retail lender goes in to look at another company about buying them, you have to wonder, what are you really buying? Are you buying a bunch of leases and office furniture and, potential lawsuits? And if that's the case, what are you buying? If there's no, especially if there's no servicing, but if that's the case, then why not just start hiring some of their branches away or some of their top producers? And yeah, that's definitely a strategy. It doesn't make the headlines necessarily, but I'm seeing a lot of that going on behind the scenes.
Yeah, and I would agree, Rob, and creating that stickiness with your sales team, and then thinking of other owners or businesses, do they truly have that same stickiness with their sales team? Because, what are you buying? You're buying production, and if they don't have the production, it's worth nothing. And I think it's very hard to, especially in this environment, it's very hard to for folks to claim that they have that stickiness. And there's definitely people out there even creating rumors about other companies that may not be selling at all, just to try to recruit their folks, for sure. Yeah.
Yeah. So here's a question, given the news that came out about Flagstar was interesting news. It was funny, Rich, before you got on the show here, I was standing here, and the ex-owner or the owner of Bay Equity, Brett McGovern, who lives up this road, stopped, briefly said hello.
Is that his backyard you're in after the Redfin sale?
What's that? Yeah, Redfin.
Backyard you're in? Yeah.
Exactly. Yeah, they're laughing all the way to the bank, right? So, but when you have an independent mortgage bank, you look at this news from Flagstar, which, as I said, kind of broke in a funny way. I get a lot of rumors, as does probably everybody on this call. They get rumors, and somebody gets laid off. Kate, let's say you get laid off. Let's say you're a loan officer and you get laid off, and suddenly you start telling people, well, gee, if they laid me off, they must be closing the whole branch. And then suddenly closing the whole branch turns into closing your region, and then closing your region turns into closing the whole company. Game of telephone that can have very serious consequences to anybody who's impacted negatively by that. But the news from Flagstar was kind of odd, because it broke on social media, and those impacted. And so I reached out to the ex-president, a woman named Susan McCann, who I have a lot of respect for, and she really knows the business. And she pretty much confirmed it, but I couldn't find anything from Flagstar. But getting back to, that's a long-winded way of asking my question to you, is you look at an opportunity, say a depository, a credit union, or a bank decides to exit lending, residential lending. It used to be the transition from bank to mortgage bank for a loan officer was onerous. It would take, 6 months or something. They weren't producing. It was a whole licensing thing. Now, have you hired people from banks or credit unions? And how does that, is that transition much smoother now?
It certainly does. I have a very live story for you, because right after that occurred yesterday, we received a call from a branch manager that they were ready to sign our offer. That's kind of been, outstanding, someone we've been recruiting for a long term. And you're exactly right. It's temporary authority has created the ability for us to be able to bring somebody on and then almost immediately be licensed with us. And, I think it's 120 days that they have to pass their test, which certainly most people in the business at this point can easily pass that test, as they've been working as a mortgage originator. So our ability to pick up the pieces of these larger banks kind of giving up their regional presence or just local presence is definitely changed with MBA's push to create that temporary authority.
And you don't have to hire an entire team when things happen like that, right? You just pick people that you really want.
The producer, yeah, because I mean, I guess with that said, we don't need a lot of other staff right now, so production is the key. Mm-hmm.
Yeah, one of the other interesting things that I noticed in San Diego, given the number of vendors who were there was a lot of vendor talk in terms of, or I should say, a lot of lender talk about vendors, about who are you using for, loan origination systems, hedging, point of sale, marketing, credit, and so on. And there was a lot of free flowing discussion that I heard, kind of being a fly on the wall, in terms of companies that are looking at different, either changing vendors or combinations of vendors and so forth. Did you have an opportunity, given the number of vendors who were there, did you have the opportunity to spend time with them? Are you seeing the same kind of consolidation in the vendor space as we're seeing in the lender space, or does everybody seem pretty set in their ways?
I think the vendors seem pretty set in their ways at the moment, but again, I don't think we've had a long enough churn of this for people to truly kind of go away that maybe weren't established yet. But I think a good point is that, of course, we have more time as lenders. So getting back into the technology groove and implementation is, of course, key. But on the flip side, as if we can look at any ways we benefit from the situation we're in, it also gives an opportunity to get into a better contract with our vendor partners, or renegotiate vendor partners, because they're in need of new customers just as much as we need borrowers to come in the door. So they're much more willing to negotiate on their pricing for, somebody that you may have been looking at for a couple of years, just couldn't figure out how to bring it into the mix. Considering taking on an extra cost, if you can get it at an extreme discount, it's a good idea right now.
This is the rundown.
Sorry. Time out for promo. Station break. Go ahead.
I was gonna say, this is the rundown with Rob and Rich. I'm Rich, he's Rob, and Kate deKay is with us this week, the CEO of Eustace Mortgage, longtime TMC member. Kate, the Fannie Freddie delivery fee increase news broke last week, right before we kind of went on air, and immediately kind of deduced this actually sucks. Your thoughts, and just talking to people this week about it.
Yeah, so it's definitely interesting. Of course, the logic behind, where they pick to increase and where they pick to decrease, you can see it's trying to open up to probably more first-time home buyer, more low to moderate income folks, because we've actually decreased a lot of the LLPAs on the lower credit score model, which of course I think that's a great thing. However, if you look kind of at the, it's almost like a target on the grid, if you to put it in a certain way. And basically that target is probably the majority of loans that we're doing as a Fannie and Freddie loan. And all of those LLPAs substantially increased. So, you know, when you look at it from a broad business perspective, we're certainly pushing through a higher rate to probably to, you know, the broad group that we're producing mortgages for right now. And then on the flip side, you know, we say, well, clearly this was a push to, you know, help affordable housing, help low to moderate income, help first-time home buyers. But then they threw this random DTI one in, and it's an increase, you know, increase in an LLPA on a DTI, which for, you know, industry folks, that's an absolute nightmare because, you know, while credit score is mostly predictable, it's not like we're not very often repulling credit in the midst of the process unless there's an expiration, and that's, you know, limited. DTI is have ebbs and flows depending on, you know, where you are in the transaction process or how good your loan officer is at calculating income. So that was really, I think, the biggest one that was of topic at the convention, just the hurdles of us managing to it. Also talking about, you know, predatory lending. It's not like folks aren't out there going to just always say your DTI is below 40% and that's the rate that they're going to quote. So putting, you know, more honest folks that are trying to be realistic at a disadvantage. So yeah, that DTI one is definitely one that we're looking for MBA to advocate on our behalf to hopefully get rid of. But, you know, as we talk about these things, while it's not, you know, previous administration pushing it down, you know, with a week's notice or something crazy, we do have some notice. But even when you're talking about a May 1st delivery and there's no interaction about it, we'll probably see aggregators pushing that price through to us, I would say some point next month.
Yeah, it's
not to toot my own horn here, but I have a great letter tomorrow that my guess is after the CFPB sees it and some of the CFPB folks actually read my commentary, I bet that the FHFA will come under some pressure to tweak that. So read my commentary tomorrow. It spells out, Kate, what you were just spelling out. There's this cyclical DTI credit score LTV scenario that makes things almost impossible to deal with when you're trying to set a rate and a price for a borrower. And they could actually, there's a scenario where if they put more money down, they end up with a worse rate and a worse price. So, you know, how does that work? So
yeah, explain that to your customer.
People not inside the industry make massive major rules about the industry. Yeah,
it's definitely not risk-based. Besides the DTI piece, the pricing grid changes on those LLPAs are definitely not risk-based.
And to be fair, we love Sandra Thompson. She is so actively seeking feedback from our members and lenders. My sense of how it's going down is Sandra's kind of going to, you know, Treasury and saying, you know, I need X amount of money to help borrowers between 620 and 679 that want to buy a home. And they're like, all right, well, find us twice the amount of money in the other buckets in case these loans go bad, just to be safe and blah, 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 blah. And you're like cutting off your nose to spite your face. In the chat last week, we asked lenders, like, roughly what percentage of your GSE volume falls inside the buckets where the delivery fees went up, and we got a mirror. I'll invite people to put the same in the chat. You can do it anonymously, just to the hosts and panelists. It was between like 70 and 85% of all loans, you know, and the bucket that is having the delivery fees reduced, that's a bucket where you have more denials, more loans that are not approved anyway. So it just, you know, when you really look at it.
But the next point is, it's like, again, I feel like Sandra is looking to create the right initiatives. But when you talk about it and you actually put it in play, that group is typically an AUS denial. And so, you know, if we're not adjusting what DU and LP are giving approved eligible on, then changing the LLPA adjusters isn't going to get us anywhere.
So you would think with, you know, all that and some of the holes and flaws that people have found in these new models, that coupled with the inevitable just flood of business to FHA that would put additional, risk and pressure, credit pressure on FHA and the MMI funds overcapitalized. Maybe that's their strategy with the MMI fund overcapitalized 5 times the legal level right now. But I mean, because right, Kate, I mean, if it enacted, this is going to cause just tons of business to go FHA, right?
Yeah, I think particularly the DTI one for sure. And the others, I think it really depends on what FHA does, because I am hearing some murmurs that they may be reducing their MI. So
I can't believe that hasn't come out yet. I mean, I'm starting to get a little worried. I mean, I remember we had Julia Gordon on, the FHA commissioner, 12 days at TMC. It was like December 1 or 2. And she made it sound like it was intimate. After I listened to her speak, I felt like, oh, by the end of the year for sure. But Jan 27, still nada.
Yeah, I think it's just a confusing message, to be honest. I think they're like, do you want to have these loans fall in Fannie and Freddie? And if you do, we need reductions in risk-based criteria on the AUS runs, or are we sticking with FHA as our core product and do that and run with it?
Should be interesting. Never a dull moment. Never. Government, man, post meltdown, obviously they were way in it, but the government is very in the mortgage industry right now. With an election season all of a sudden kind of right around the corner, and housing again, it's kind of a top issue right now. Rob, anything you're hearing on this delivery fee stuff or FHA migration of business or potential rollback? I think here's what you're alluding to, a prediction that they would roll this back.
Yeah, I think I'm gonna I don't know if Sandra Thompson reads my commentary or not, but I'll send her a version and she'll write back a nice little note. But there are ramifications when one agency, the FHFA, if that's an agency, I think it is, makes a change. And what is the impact on FHA and VA? What is the impact on rural housing? What is the impact in other parts of the housing ecosystem? It all ties in together. I think that they will change. And I know Philip asked a question about, are they going to roll it back or tweak it? They'll probably tweak it. There was some reason why they did it, to focus on underserved borrowers. And if they are focusing on underserved borrowers, what is the impact of that on, say, FHA lending? Because so much of FHA lending targets that group. So yeah, it's funny, but Rich, I need to open Kate's kimono here a little bit, because we were sitting there at this event, it was day before yesterday, and I said to Kate, look at Kate. Kate's getting nervous already. So
I'm getting nervous.
Luckily, we weren't around each other when I had too many drinks yet, so I feel a little bit safer.
No. So I said, Kate, are you ever bored by this business? And she looked at me like I was from Mars, and she said, are you kidding? This is the most exciting business ever. Every day I go to work, I'm energized. There are new things happening. We're helping borrowers. Very, very enthusiastic. So Kate, hats off to you. So Rich, I'm glad you got Kate on the call here, but there is a lot happening. And I think that, interestingly enough, if you look at we're kind of knee deep, obviously, or neck deep in mortgage banking. But if you look at it from a nationwide point of view, as we said before, Rich, there's nothing really broken right now about housing. There's nothing really broken about lending. Yes, there are a lot of changes that can be made, especially with regard to housing and affordable housing and supply and demand and so forth. And you got the Srbinski plan that keeps floating around Congress. I know maybe it's time to revisit the.
I would argue that
inventory
issue, the housing inventory system and issue in America is broken. I would argue is broken. The housing finance, not at all broken. I think that's, I can always critique things, but
you would think, somebody sent me some Goldman Sachs forecast, and it was something about, oh my gosh, we're gonna, these 4 markets are going to tank, just like they did in 2008. And I'm sitting there reading these Goldman Sachs forecasts saying, Phoenix is going to plummet and San Jose is going to plummet. And I'm thinking, what the heck? And then you hear these stories about builders scaling back their production. And you would think if inventory was in such great demand, builders would not be scaling back their production. They would be, gobbling up swaths of land, 20 minutes near San Francisco to build, 300 homes. And they don't seem to be. So,
well, because they can only build homes
cycle.
that are, what is going to be greatly in demand is the homes they won't build. That's the problem.
Yes.
The homes
Well, I was just going to go there, and the production costs, in terms of, the permitting costs, for example, and the ability to get water piped in and so forth and so on. It's, you could say that that's broken, reflecting in broken inventory system, but you would hope that supply and demand take over. And plus, on top of that, there's really no, puppeteer's hand above all of it to make it work. It's all because it's so disjointed. You're right. That part is fractionalized, and that's causing major problems, especially with inventory. But yeah, housing and so forth, let me phrase that differently. I would say it's not a big issue in terms of a politician, or, I don't think housing or finance was a big issue in the election in November. Maybe it will be in 2024, but probably not. We're functioning as an industry. We're making loans, things are getting done. You're right. Inventory is an issue, but that's not a national issue so much that a politician is going to really latch onto and carry over the goal line, if you want me to use some more sports analogies.
A year from now, I will guarantee it, they're going to be forced to deal with it, and it's going to be bad issues. It might be 2 years, a year, but what's going to happen this year, I'm telling you right now, is the Fed's doing a good job with inflation. We got rates in the 5s now. Apps are up 10% week over week, last couple of weeks. I think you have home buyers that are starting to make peace with higher rates that are not historically crazy. I think you have home sellers that are starting to make peace with, if it's cutting prices or concessions. I think you're going to have a very healthier than expected purchase market this year, and home values are going to continue to go up. We're on the little reset now. The crazy cities are getting their reset. But if you live in Cleveland or Milwaukee or Chicago, home values are going to go up this year, and affordability is going to become a massive issue like a year from now would be my prediction, but we'll see.
Yeah, I agree. And I certainly wish we could get someone, more on our side, politician wise, that sees this as an issue. New Orleans, surprisingly, is ahead of the game on this, and we do have a rule for new developments that require affordable housing, a percentage of affordable housing be built within it, or rental, or whatever the case may be. Honestly, the percentage is fairly low, but there's of course incentives that go along with the creating the affordable housing as well. And I think if we just don't get into a direction that helps the issues that Rob talked about, with the reasons that we know why builders aren't building that in the first place, and we can create some sort of incentives around it as well, or at least have requirements be built in within whatever the other building is that they're doing that is not in an affordable housing atmosphere, we would at least get somewhere. And we've taken no steps to fix it.
Yeah, nothing's being done at all, and just continue to get worse. But Rob,
I can't quite see, but have there been any questions asked that we need to address while we've got Kate and we're dwindling away here a little bit on time?
There's actually a great comment in the chat from Dottie, very loyal fan of the show, saying, I would like to see a true one-time construction product available through the GSEs. It may allow builders to develop affordable single family without carrying all the costs. Dottie, this is an incredible idea. This is something I've talked about for a long time. That GSEs actually were close to doing this. I remember distinctly because we were talking with them about it through our partnership. Right before, when Mel Watt was the head of FHFA, like they almost had this done. And then he had that sexual harassment thing and he went away and it got railroaded. But the GSE is offering an affordable C2P product, it would help independent mortgage bankers make construction loans. It would help builders with costs. It would help a lot of things. There is some interest rate risk to the GSEs on it, having to offer a fixed rate for 9 months essentially, but you could bump it up a little bit and, mitigate it in other ways. So that was the only thing I saw in the chat. Kate, any thoughts on that? One close C2P?
Yeah, I mean, I know they are doing some manufactured home kind of programs that are similar to that and pushing that along with affordable housing. But, I think even more targeted towards builders. Of course, I think you just open the doors for the, MSAs, joint venture type people to just gobble all that up, and no one else really have an opportunity to do it. And then you have people that are just interested in making a lot of money and probably not affordable housing. So I don't know.
That's a great point. That's
Yeah.
a very valid point to that. If you did do that through the GSEs, you'd see a lot of the realtor-esque marketing services agreements with the builders ramp up like crazy. The builders would love it because that's more money for them. So
Right, the builders with their, mortgage companies tied to them, I think you would just see that fall right into that category, and they're not typically looking out for the best for their customers on the mortgage side.
excellent. What else in the news this week? There's been a lot of positive reports. Pending home sales, new home sales, both up for the first time in December, first time in many months for both of those, and just a general sense that the mortgage market is kind of coming to life. And Kate, I would assume, like most, you've seen better app activity these last few weeks and some general optimism to start the year, which is good, especially the way Q4 was last year.
Yeah, agreed. I think, again, that's a lot of the reason why it seemed a little bit more positive here at the recent conference, and just people are starting to see, I believe, the light at the end of the tunnel. I still think Q1 is going to be really tough. It's just turning a little bit off of where Q4 was.
Rob, anything else in your inbox or discussions this week at the?
I had a question, Kate, because it came up some at the conference this week. And earlier I mentioned, a lot of talk about vendors out there, and of course there's a lot of talk about the fact that a loan costs more than $11,000 to manufacture. And lately the whole credit situation has been a topic. And yesterday I went to like the last session of the conference, and there were some folks there talking about, well, I'm not really too much allowed to talk about what they were talking about, but when you look at the cost of loans and you look at the cost of credit and how many players are in the credit quote space, do you think have you changed the way that you do business, given the fact that getting a credit score, running credit, verifying credit has gone up? Have you instructed the loan officers to do something different because of the cost of credit?
So it's interesting, and this, ties in with the Work Number issues as well. They're both just outrageous on the consistent increases in their charges. Of course, very frustrating for us, given the environment, and just in general, certainly seems like price gouging. And we've changed our, there's some like waterfalls that you can put in. We've had a lot of that in place. So, if this, then that, then it only gives you one credit score. And I think when we have to get to the system, and I know it's available, and a few folks vendor wise have it available, but I would like to dig in further on, can you get an AUS to run with one credit score? But then also, how realistic is that AUS run? Because if the other two scores are, whatever, 20, 50, 80 points lower, is it a valid AUS? And so I certainly think there's ways to develop and even go further down than we have, because we have changed our practices, but not to the extent that it's causing a massive decrease. And because we do pass most of that cost through to the customer if they close the loan. So it's really just the pre portion that you have to kind of figure out what's the sweet spot. and what is still giving your customer valid information, because you certainly don't want to say you have a pre-approval or, AUS approval, and then it just rolls back because you didn't get a full picture of their credit. So, and because, of course they're charging us more, but then all the bureaus aren't equal. Some get some items reported and some don't. So then you just don't necessarily have a valid credit score or a complete picture of the loan file if you're only pulling one. So it's definitely a tricky path to go down. I think even more so is them on top of charging us more, also selling our customers as leads. I think that part probably angers me more than the cost increase, or I guess a combination of the two. Because we'll have customers getting called 200 times by very pushy other lenders that are obviously very hungry for business, and that was definitely a big topic on what if anything can be done for that to stop.
Yeah, I printed out the what is it, optoutscreen.com or www.optout.com many times. Maybe I'm due for another one. And when I put that out there, some people will write and say, well, by the time the borrower fills that out, it's too late, or whatever they
You're
say.
correct. Yeah.
So due
Yeah.
for a repeat.
Right.
Kevin.
Once they do it, then basically it only triggers, well, first of all, of course, it has to record, which may take a week. And then the people that already received their lead can still keep calling. It's only anybody that would get it after that.
Yeah. Well, it's like you said earlier, like Rich said, it's always something. We're tweaking. I remember some years ago, it seems like the industry is always encountering these things, whether it's LO comp or TRID or the new 1003 or whatever it might be, that we're gonna, it's gonna doom us and woe is me and so forth. And as an industry, we're like that, the clown that you hit and it pops back up, as an industry, we tend to pop back up, and gee, the CFPB didn't put an end to mortgage lending and so on. So
yeah,
anyway.
2019, Amazon and Costco were going to put us out of business, but
oh yeah,
look how far
right.
that's gone. And then you see stories like Better with their one-day mortgage, and it's I think a lot of it is more people that are in fear of technology taking over. And I just say we're so slow in the industry to adapt to technology. I don't see that happening.
We still don't have e-close fully.
Right.
What is it? It's a stone tablet and a chisel. I just unbelievable to me. If you would have told me 10 years ago we wouldn't have e-close in 2023, I would have slapped you in the face. Honestly, it's it's insane. It is crazy. But listen, if you're a technology company, I hate to say it, this is a tough industry to go into. It's so freaking up and down, and it's one silo, and it doesn't mesh with other financial services always. So I think that's part of it too. But it is certainly frustrating to lenders and leaders like yourselves, Kate, that we still have a process that is still this manual is kind of batty. But anyway, we're optimistic note now. So, after the fourth quarter of doing the show was set me into a deep drinking phase. So luckily, January has been much more rosy. And
are you dry January, Rich?
No. Let's not get crazy.
Oh, wet.
I am in the mortgage industry.
Full speed ahead.
I know Rob and I aren't, because I just saw him. So
Rob once had a dry Tuesday back in 1984. Yeah. So, but
yeah, I'll never forget it. It was rough.
Oh, anything else before we take this show to the weekend? Kate, any weekend plans in the Big Easy?
Well, we're rolling into Mardi Gras, so now that I'm home for a bit, I'm going to be in full Mardi Gras prep mode.
Last time I was in New Orleans, unbeknownst to me and you, the pandemic was starting with all the free Mardi Gras. Yeah, we were just part of that. TMC was in New Orleans a week before all hell broke loose with the pandemic. So Rob,
got some fun out before the pandemic, right?
We did. That was very fun. Yes. Too fun, potentially. Rob, anything going on in the Nottingham Forest this weekend?
Not that I know of. I'll keep an eye out for Little John, but no, playing some hoops tomorrow morning, and it's kind of an average weekend, actually.
There you go. All
Doing,
right.
doing my thing, working on Monday's commentary. That's what I'll be doing much of this weekend.
Good stuff. Excellent. Well, as always, thank you very much to all of our attendees. We're here every Friday live at 3 p.m. Eastern on the Rundown. We're here live, also on YouTube after the fact, and on podcast where most of you listen. If you're listening live, don't subscribe to the podcast, TMC Connect, Apple or Spotify, and get the show in your feed. So Kate, thank you very much for joining us on No Notice. Great as always. Appreciate you.
Yeah, thank y'all for having me. I always love to talk to you both.
And Rob.
Yes, thank you very much.
Good seeing you, and sure I'll be talking to you. And have a great weekend, everyone. Take care,
Bye,
guys.
everybody.